Hello, hello, everyone. Welcome back to Words of Wisdom, Episode 3. Charlie Bilello here. And on this show, we take a quote from a famous investor and I break down how you can apply it to your own investing journey. Today, we're going to be talking about a quote from the great Jack Bogle, founder of Vanguard Group. A lot of wisdom from this man. If you haven't read his books, you definitely should. Common Sense on Mutual Funds, an absolute classic. Here's the quote I want to talk about. Don't look for the needle in the haystack, just buy the haystack. And you might be wondering, what do needles and haystacks have to do with investing? Well, they have everything to do with investing because needles in this case are individual stocks and the haystack is the broad market. So when you're just starting out as an investor, what you hear about is the needles. You hear about the individual stocks that have these great stories behind them, the Apples, the Amazons, Nvidia, the stocks with the huge returns. And the assumption is that you need to find these types of stocks to do well as an investor. You need to find the next Apple, the next Amazon, the next Microsoft in order to do well as an investor. And if it was easy to pick these stocks in advance and hold on to them, that might be a good strategy to pursue. But as it turns out, it's very, very difficult to pick these stocks and outperform a broad market index. And every single study that we've had on both individual investors and professional investors has shown that very few of these investors have outperformed the markets by picking individual stocks and trading in and out of these stocks. Here's a famous study from Barber and Odin looking at 66,000 households, so not a small sample size. And what they found is that the households that traded the most, that had the most activity in and out of stocks, actually had the worst performance from 1991 to 1996. They had an 11.4% return per year, while the market returned 17.9%. So huge gap, and they're attributing a lot of this to overconfidence. The investors, the more confident they were, the more likely they were to trade, and the worse they were likely to perform. And their conclusion from this huge study was simply trading was hazardous to the wealth of these households. And you can see that pretty clearly on this chart here, looking at net returns versus turnover. Net returns, the white bars, turnover, the blue bars. And you can see as turnover goes up from low levels to high levels, the worse the returns become. Another important study here from Barber, Odin, and Zhu, looking at individual investors and their tendency to exhibit herd behavior. And herd behavior is simply everyone piling into these stocks, these hot stocks that they're hearing about at the same time. And what often happens is many of these investors jump in after a big move. And because there's mean reversion in markets, many of these stocks will pull back, and investors, after they go down, will be selling these stocks. So, of course, investors are buying high and selling low and repeatedly doing that, and that's leading to underperformance. And what this study found was that the stocks that investors bought, if you look a year later, actually did worse by 4.4 percentage points versus the stocks that they sold. So these investors would have been better off buying the stocks that they were selling and selling the stocks that they were buying. So why do individual investors perform so poorly? It's not just one factor. Barbara and Odin are looking at 5 different factors here. Number one being asymmetric information. You don't likely have better information when you buy a stock than the person is selling it to you. And many times you're trading on reasons that have nothing to do with the fundamentals of the company. You have liquidity needs, you have rebalancing, you have tax management, and these are not factors that are going to lead to an expectation of outperformance. Number 2, overconfidence. We talked about this. You believe that you know more than someone else. You know more than the market or the average person. Well, the markets are very efficient, and it's unlikely you have some type of information, some type of edge that's going to lead to outperformance. Number 3, this has become a huge one of late, sensation seeking, investors simply trading for entertainment or gambling purposes. It's exciting to buy a stock. It's much more exciting to buy a stock than an index, which seemed to be boring. There's a story behind it. A lot of investors are thrill seeking, and they're using this for entertainment, and that's not likely to lead to outperformance, of course. Familiarity, investing in geographically or professionally familiar stocks. So this is the case where investors are buying stocks that are near them in terms of the locations, companies they know, Or if they're working in the tech industry, they're more likely to buy tech stocks. If they work in the financial services industry, more likely to buy financial stocks, and that leads to worse performance. Lastly, and this is a huge one, anyone who's traded individual stocks before is likely familiar with this because we all have this innate tendency, the disposition effect. And this is the tendency where we sell our winners early. So you've probably heard the saying, no one ever went broke taking a profit. Well, in order to achieve those enormous gains that I showed earlier in terms of the biggest winners over the last 30 years, well, you can't take profits. You have to let your winners run. And the way our psychology is made up, we want to take that profit. We want to lock in those gains. And on the opposite side, when we have losing positions, we tend to hold on to them and we hope that they come back. We hope that they get back to even. So this disposition effect, an additional factor that's hurting individual investor performance. So this is just one example. We're looking at the retail side of things, and some people might say, okay, I acknowledge I can't likely outperform the market by picking individual stocks, but what if I outsource that to professional investors? Surely someone who's doing this all day long, researching companies, surely they should be able to outperform. Problem is, they suffer from the same things that retail investors suffer from, which is the absolute extreme difficulty in outperforming the market. Here's the latest data from S&P Dow Jones looking at all different US equity funds and the percentage of funds that underperform the S&P 1500. You could see here goes up with time. So even if you outperform over a given year, which will be many funds that do so, you're not likely to continue to outperform. We can see here over a 20-year period, 97% of these funds have underperformed the S&P 1500 on a risk-adjusted basis. So the temptation is to look at short-term performance, look at one-year returns, look at three-year returns, and buy those funds that do the best. But there's no persistence in performance, so you can't guarantee that those funds are going to continue to outperform. And what studies have actually shown is the opposite tends to occur. So the best performing funds over a 3-year period are more likely to underperform over the following 3 years because there's mean reversion in terms of returns. So if we look at that 97% number, some might say, well, let me just buy the 3% that have outperformed. But once again, that only works if you assume that they're going to continue to outperform. And historically, that hasn't been the case. Now, is this true across all equity funds? This is an important point. It's not just one particular style. It's large caps, small caps, mid caps, value funds, growth funds, core funds. Everything within the equity space is underperforming their benchmark over a 20-year period, over 90% across the board. So it's not just one category. It's everything within the equity space. Now, let's talk about equities versus treasury bills. And this is probably a question that seems absurd. Do stocks outperform treasury bills? And you're probably thinking, of course they do. Why else would I invest in stocks? And if we look at a broad index like the S&P 500, you can see they clearly outperform 9.8% per year since 1928 versus 3.3% for treasury bills. So not every year, of course, but over long periods of time, stocks outperform treasury bills because you're being compensated for the higher risk in the stock market. Now, while this is true of the broad market, this is not true when picking individual stocks. Huge study that was done by Bess and Binder looking at shareholder wealth enhancement. They looked at data from 1926 to 2022, and what he found was 58.6% of these stocks underperformed treasury bills during their lifetime as a public company. So if you're just randomly picking stocks or throwing darts and picking stocks, you're more likely to pick a stock that's actually going to underperform something as simple and boring as treasury bills. The odds are stacked against you. And here's the bigger point that Bess and Binder found in that study. It's that a very small percentage of stocks are leading to the vast majority of lifetime wealth creation. So if we're looking at this table here, we're looking at 3 stocks contributing 10% of all of the market's gains over the long run, just 72 stocks contributing 50% of the gains, 966 contributing 100% of the gains. And if we're looking at how many stocks there have been, 28,000. So it's a very small percentage of stocks that's leading to all of the gains. We can look at it here on a percentage basis. 0.26%, 50% of the gains, just 3.4% of stocks leading to 100% of the gains. And what you might be saying is, well, why don't I just pick those few stocks? Why don't I just pick the stocks that are on this chart right here? Apple, Microsoft, ExxonMobil, Amazon. Why don't I just pick these stocks and I'll get outperformance? I'll get all the gains of the market. These 11 stocks right here, 20% of the overall gains. The problem, of course, is if you don't pick one of these stocks, if you miss out on one of these stocks, your performance is going to suffer. If you don't own these biggest winners of the past 30 years, even a few of them, that's going to hurt your long-term return. So there's really only one way to guarantee that you're going to own all of these stocks in the long run, and that's by buying everything, by buying the haystack, by buying the index. And if we look at the S&P 500 over the last 30 years, it's done extremely well because it's owned all of these big winners over time, and the losers, of course, go down in value and their weighting becomes lower and lower. So if we look at the S&P 500 last 30 years, 1900% return, that's 10.5% per year, and you earn that return without having to do anything. You haven't had to do any individual stock research. All you're doing is participating in the broad advance of the market where the best stocks rise to the top and you own those stocks. You're guaranteed to own them. Now, if we're looking at an index fund, the best thing that you can say about it is that with time, your odds of performing go up. So unlike an individual stock where you can buy a stock and 20 years later it can be lower, and you're not sure if it's going to even be around 20 years from now, the index, the market is always going to be around, and the odds are in your favor the longer you hold it. And I'm showing you here the odds of a positive return for the S&P 500 from 1 day to 30 years. And you can see if you're a short-term trader, you're just looking at a day or a week, your odds are only a little bit better than a coin flip in terms of having a positive outcome. But as if you go out in time, your odds go up. Looking at out 1 year, 75% of the time you're positive. Out 20 years, 100%. There's never been a 20-year period where the S&P 500 has had a negative return. Obviously, we can't say that for individual stocks. Many of them have negative returns, and many of them aren't around 20 years later. This is the most important chart for an investor to look at. It's the impact of time and compounding on your portfolio. So if you're an investor in a broad-based index fund, what you should be thinking about is having a long holding period. So the big returns, the big money is in the big move, and the big move comes with time and compounding. You can see 10-year returns, 170%. This is the median for the S&P 500. 20 years, that jumps up to 720%. And 30 years, the median return is over 2,000%. And again, you're receiving this return without having to pick individual stocks. So not true, that assumption that you need to pick individual stocks. You need to find the next Apple or Amazon or Microsoft in order to do well as an investor. Actually, the opposite is true. Most investors will be doing better by not trying to pick those companies, by owning everything, by not looking for the needle in the haystack, just owning the haystack. With that, we'll end it right there. Thanks, everyone, for watching Words of Wisdom. If you're watching this on YouTube, hit that subscribe button for more content just like it, and I'll see you next time on Words of Wisdom.